Retained earnings represent the portion of a company's profits that are kept in the business rather than paid out to shareholders as dividends. They are a key part of a company's equity and show how much profit has been reinvested over time to support growth, pay off debt, or save for future needs. Let's break it down with a simple explanation and example. When a company earns a profit, it has two main choices. It can distribute the money to shareholders as dividends or retain it to reinvest in the business. Retained earnings are the cumulative total of all profits that haven't been distributed. They appear on the company's balance sheet under the equity section. Here's a simple example. Imagine a company, TechGear, earns $100,000 in profit this year. It decides to pay $30,000 in dividends to its shareholders. The remaining $70,000 is added to retained earnings. If TechGear already had $200,000 in retained earnings from previous years, its total retained earnings would now be $200,000 plus $70,000 equals $270,000. Retained earnings are important because they reflect how much a company has reinvested in itself. Businesses often use retained earnings to fund operations, expand production, develop new products, or reduce debt. For example, if TechGear uses its retained earnings to purchase new equipment or hire more employees, it's reinvesting in growth rather than relying on external funding. However, retained earnings don't always mean the company is doing well. If a company consistently reports losses, its retained earnings could become negative, which is called an accumulated deficit. This can indicate financial trouble or inefficient management. On the flip side, too much retained earnings without reinvestment or dividends might frustrate shareholders who expect a return on their investment. Retained earnings are also closely linked to a company's growth strategy. High-growth companies, like tech startups, often retain most of their earnings to fuel expansion and innovation instead of paying dividends. Mature companies, like utilities, may distribute a larger portion of profits to shareholders because they don't need as much reinvestment. In summary, retained earnings are the profits a company keeps to reinvest in the business rather than distributing to shareholders. They are a key indicator of how a company manages its profits and plans for the future. While positive retained earnings show financial stability and growth potential, they should be evaluated alongside the company's overall strategy and performance.